Tonight, when the market drops, your stomach drops with it. Your hands get a little colder. You open the app, you close the app, you open it again. But somewhere else, right now, someone with far more money than you is doing something strange. They are buying. And the real answer for why is far stranger than they're just rich enough not to care. Your brain and their brain are running two completely different programs. Same crash, same red numbers, same headlines screaming collapse. But one brain sees danger, the other sees a sale. Why? Start with what's actually happening inside you during a crash. Your amygdala, the small almond-shaped alarm system buried deep in your brain, does not know the difference between a falling stock chart and a falling rock. It just knows something is falling, and falling is bad. So it floods your body with cortisol. Your thinking slows down. Your instincts speed up. You are, in this moment, biologically built to run. This isn't a flaw. It kept your ancestors alive. But it is spectacularly bad at picking stocks. In the 1970s, two psychologists named Daniel Kahneman and Amos Tversky sat down and asked a simple question. Do people actually make decisions the way classical economics assumed, weighing gains and losses evenly? They found the answer was no. Losing money, they discovered, hurts roughly twice as much as gaining the same amount feels good. They called it loss aversion. It's one of the most replicated findings in behavioral science, and it explains almost everything about how you behave when your portfolio turns red. When your account drops 10%, your brain doesn't calculate 10%. It calculates the feeling of watching your effort disappear. And feelings, unlike math, want you to act immediately. Sell, get out, stop the bleeding. Here's the strange part. The people who build the most wealth over long periods are not the ones who feel less fear. They feel it too. What's different is what they do next. Warren Buffett has said, in various forms, for decades, that the goal is to be fearful when others are greedy, and greedy when others are fearful. It sounds like a slogan. It is actually a description of a discipline that goes directly against your nervous system. It asks you to do the one thing evolution never prepared you for, to see a falling market and think opportunity instead of danger. But why would falling prices ever be an opportunity? Doesn't a crash mean something is actually wrong? Sometimes, not usually. Benjamin Graham, the economist who mentored Buffett, described the stock market as a business partner he called Mr. Market. Every day, Mr. Market shows up and offers to buy your shares or sell you his. Most days his price is reasonable, but some days he's euphoric and offers absurdly high prices. Other days he's depressed and offers absurdly low ones. Graham's insight was simple and radical. You are never required to trade with him on his terms. You can ignore him when he's panicking. You can even take advantage of his panic. That's the first difference. The wealthy don't see the market's mood as truth. They see it as noise layered on top of value. A company that makes real products, earns real revenue, and serves real customers doesn't become worth 40% less overnight just because everyone else is scared. Its price changed. Its worth mostly didn't. Sometimes, not usually. There's a historical moment that shows this with almost eerie precision. During the 2008 financial crisis, as banks collapsed and headlines predicted the end of the global economy, most retail investors pulled their money out at the bottom, locking in devastating losses. Data later compiled by researchers studying investor behavior during that period found that the average investor's return badly trailed the market's own return over the following years, precisely because of when they bought and sold. They panicked at the bottom and hesitated at the top. Meanwhile, investors who held steady or who bought more during the worst months participated fully in one of the largest wealth-building recoveries in modern market history. This pattern isn't new. It isn't even modern. Sir John Templeton, one of the most successful investors of the 20th century, built part of his fortune buying shares of nearly every publicly traded company on the New York Stock Exchange priced under $1 in 1939, right as the world was heading into war and pessimism was at a peak. Most of those companies weren't good businesses, but because he bought so broadly, at such depressed prices, when panic eventually faded, his returns were extraordinary. He famously said that the four most dangerous words in investing are, "This time it's different." Panic always feels unique while you're inside it. Historically, it rarely is. So here's the counterintuitive twist. The rich aren't smarter during a crash. They're not calmer by nature. Many of them are just as anxious as you are. What they've built, often over years of deliberate practice, is distance between the feeling and the action. They've pre-decided, before the crash ever happens, what they'll do when it does. Economist Robert Shiller, who has spent decades studying market bubbles and the psychology behind them, has pointed out that markets are driven by narratives as much as numbers. A crash is, in large part, a story spreading faster than facts can correct it. Once you recognize that the story and the underlying value are two separate things, you gain the ability to respond to one without being controlled by the other. This is where the modern mirror becomes uncomfortable, because you do this too, just in smaller, quieter ways, every day. You panic sell a stock the moment it dips. You avoid checking your retirement account for weeks after a bad news cycle. You feel a flash of superstition, a sense that if the market is falling now, it will probably keep falling forever. That feeling isn't information, it's your amygdala, running the same ancient program it's always run, applied to a modern financial system it was never built to understand. The wealthy who navigate crashes well have usually done one unglamorous thing. They've decided their strategy in advance, in calm weather, so they don't have to make emotional decisions in a storm. They've asked, before anything drops, what they would do if their portfolio fell by 30%. They've written the answer down, and when the drop actually comes, they're not deciding, they're just following instructions they gave themselves earlier, back when they could think clearly. There's something almost anticlimactic about that. You might expect the secret to be a hidden strategy, a private hedge fund trick, some system unavailable to regular people. Mostly, it isn't. It's closer to a rule you agree to follow before the moment it gets hard to follow it. Which brings back the question from the beginning. Why does someone with more money look at a crash and see a sale, while you look at the same crash and feel the floor disappearing? It isn't because they have more money. It's because they've made peace, in advance, with the fact that markets fall. Not once, not rarely, regularly and unpredictably, as a permanent feature of how markets work, not a malfunction of them. Historically, markets have dropped 10% or more almost every single year, and dropped by 20% or worse every few years, and every single time, over long enough periods, they have eventually recovered and gone on to reach new highs. Knowing that pattern in your head is easy. Believing it in your body, in the middle of a red screen and a falling number, is the actual work. Tonight, when the market drops, and your stomach drops with it, that feeling isn't wrong, it's just old. It's a system built for falling rocks, not falling charts. The question isn't whether you'll feel it. You will. The question is whether you'll let a 100,000-year-old alarm system make a decision about money it was never designed to understand, or whether you'll have already decided, back when things were calm, exactly what you were going to do.